Good morning. Hello and yate. My name is Wesley Benali, National Travel Practice Leader for REW. And thank you for joining us today for our last of three-part webinar series of tribal finance workshops. At REW, we do our best to ensure that the managers and decision makers have the information to make informed financial decisions for the betterment of their organizations. Today will be a workshop on inflation and the impacts it may have on your operations. Inflation exerts significant impacts on various aspects of the economy, including purchasing power, financial markets, savings and investments, income distribution, and government finances. Recognizing and addressing these impacts is crucial for policymakers and individuals to navigate the challenges posed by inflation, and our wealth team will be providing some good tips on how to do so. Thank you very much, and I'll turn it over to Paul Madrid. Thank you.
All right, thank you, Wes. Welcome to everybody. I'm Paul Madrid. I'm in our wealth management practice. I have two of my colleagues here, my other principal partner, Rob Elsols, and then we also have Rob Papelian, our chief investment officer, one of them. So we're happy to have you here today. The plan, let's go ahead and kind of walk through this agenda here so we can see what will come up next. So just wanted to, as Wes mentioned, we want to talk about the impacts of inflation and what that really does to you and how it impacts everything, but also how interest can help offset some of that inflation impact. Later on, we'll jump into some breakout sessions, or depending on kind of the flow, I may do just one big breakout. But overall, I just want to cover how to kind of go through a simple calculation on the income benefit, and then also walk you through like the initial steps to compile an investment policy. So the IPS, if you hear me say that stands for investment policy statement. But again, we'll get into some action there. And then later on, we'll wrap it up with some next steps. I'll kind of walk through a scenario analysis and a few things. But with that, let's go ahead and kind of get started. My first piece, again, wanted to just touch on the impacts of inflation and wanted to start out with this chart. So a lot going on here. What I'm going to do in these first few slides is just give you some insight of inflation, where we're currently at, where we've been, and then kind of go through some of the impacts and how that works. But this slide here that you're looking at, it's showing year-over-year changes on the top related to the different components of inflation. And then the bottom part, that's showing just kind of a heat map, we call it. So red meaning, hey, inflation's higher on a monthly basis, and blue meaning that it's cooling, or at least cooling at a slow, not really cooling, but growing at a slower pace. So let me focus on the top piece here. You can see there's different segments here. That big one that hit the top, which is I guess kind of a blackish grayish line. You can see it peaked here in the middle of, let's say, March 2022. That was goods. So goods got really expensive kind of springtime last year. Y'all probably remember some of that, and some of that could have been attributed to just like lumber. You may have heard about all those high prices at that level. If you're buying a home, it was pretty expensive. But the good thing is that has started to slow. You can see on the far right, it's one of the lowest numbers there. On the flip side, one that's increasing more recently is the service sector, and year over year, that's been about 6.8%. So there are different components of inflation that impact us over time, but just wanted to point out there's a lot of varying pieces to that, and I'll go over some more in a moment. On the bottom, I wanted to point out that the colors are all over the place, especially on the left side. That's the part of the reason why the Federal Reserve was raising rates. They needed to cool down inflation. And you can see on the right side, more recently, they are being successful with that. But it does have some consequences eventually on slowing down the economy overall. But anyway, just wanted to kind of give a breakdown of where we've been, what's kind of driving it to some extent. But this next slide will kind of give you some more insight on that. So this one is a similar inflation chart. I'm going to focus on the left side. The left side is showing all the contributors to core or just to overall inflation. and it's color coded. So just bear with me. We have energy is green on the top. If you remember last summer, paying for gas, it was pretty expensive, right? So you can see that was a pretty high component of inflation last year. It even peaked when inflation peaked at 9.1%. That's when we saw oil pretty expensive, and just gas at the pump pretty high. Other pieces in red here are new and used vehicles. It started to slow down more recently, but you can remember during I guess 2021 and going into 2022, it was hard to find a car. So those prices got really high, and even used cars got expensive there. Then we have food at home, which is the purple bars. That's starting to be a smaller component of inflation, so it is cooling. But I do remember trying to go get some just fruits and vegetables and noticing like, hey, that's more than double than it was about a year ago that I remember. So food inflation was contributing. So a lot of things were going on. The bottom piece is the bluish, the dark blue on the very bottom. That's housing essentially. So rents and just if you're owning a home, you probably have seen and have noticed just the cost of living has been up quite a bit. And it seems like it's still staying kind of high. And then the light blue area is restaurants, hotels, transportation. If you try to travel recently, we'll touch on that in a moment, but that cost is getting more and more. On the right side, these are just a little more detailed explanations. You can see the biggest one is red. Transportation services are being the largest component of inflation lately. The good news is this little on the bottom right, that light blue piece. Good news is airfares are getting a little bit cheaper. I remember last summer when I traveled, the airfares were pretty expensive, and they've been pretty expensive for a while. So it is good to see that the prices are getting a little bit lower there. But other components I won't go over, but you can see they're all having some contribution to inflation overall. All right, so bottom line is inflation does impact us. And I got a slide I'll show you on how that really means just from a simplistic standpoint, but it reduces your purchasing power. And if your money is not growing at the rate of inflation or better, you're actually losing money. So an old saying that you don't really want to keep all your money stacked under your mattress, because you're just going to lose that value or that purchasing power over time. And same at the bank. You don't want to just leave it in the checking account and not really gain so much interest. So in fact, we've seen a number of tribes historically that would leave it in cash, and it wasn't really helping them overall. And here's a kind of a visual of that and what that looks like. So a year ago, if you had $1 million in the bank or in the checking account, wherever you had it, and you didn't do anything with it, you were just holding it there. This is the case for a lot of ARPA funds that came through. Just tribes weren't investing it. They left it there. Fast forward till today, and this is just assuming about a 6% inflation over the last 12 months. Now your value is only worth $940,000. So that's $60,000 of purchasing power that you lost, which is pretty significant. If you think about it, that could be a wage for somebody or two part-timers, whatever that may be. That's quite a bit of inflation that is impacting us. And if you think about it, over the last 2 years, inflation has kind of averaged around, let's call it 6% or so. So you can even double that. If you haven't done anything with your cash for 2 years, probably only about $880,000 of value after 2 years. So it does have an impact. In fact, this top part of it, the top blue, you can't see it, but it's really saying 60,000. That component gets bigger and bigger as you do less and less over time. All right, so how do we go against that? What do we do? Interest income. So interest income is a way you can just earn money on your investments. It could be a number of ways. I've done some webinars in the past related to this, but there's ways that you can use a money market fund. You can buy individual securities, government securities, all that kind of stuff, but they do pay interest. Since inflation reduces the purchasing power, the income will help offset that. We just got our inflation number, I think it was yesterday or the day before, where inflation's still above average. So 4.8 for core inflation and 3% for headline inflation. Just to give you a quick idea of what the differences are there. Headline inflation will include energy and food prices. Core inflation does not. The reason why they usually strip out energy and food prices, as you saw in the previous few slides, that energy component's pretty wild. It will be very high sometimes and very low other times, but same with food. You may notice the price of a watermelon last year may have been higher than it is this year, so it's pretty volatile overall. So that's why they tend to look at the core inflation overall. But just thinking about core inflation, 4.8% over the last 12 months. If you had $1 million just sitting on the balance sheet, not doing anything, that's $48,000 lost of purchasing power over that time frame. So it's a good opportunity to do something with those funds. All right, let's move on to just kind of a real life scenario to show you what likely you can get for just investing in a U.S. government security. So here, the purplish bars are just showing your principal essentially. Let's say you had $2 million. If you were to build a strategy right now and say, hey, I want to put the $2 million in a 1-year government security or a 2-year government security. This is a couple days old, so it may be outdated, but not too much. But at any rate, if you bought a 2-year government security, you would get about 4.5% interest. And you can see here that interest income benefits pretty significant. If we were looking back 3 years ago, inflation was very low, interest rates were close to zero. That didn't have much impact, but now we're actually getting paid for that cash that we have. So similarly with that 1-year rate, about 5%. In this case, it's going to be about $100,000 of income that you can get for $2 million versus just leaving it at the bank. So these are just some good examples, and I'll speak to why you see that 2-year rate lower than the 1-year rate in a moment. Generally, it's the other way around, but just wanted to show you like, hey, there's opportunity to make some income, especially if you don't have any needs here in the short run. All right, so just some general considerations before that I'm going to go into a little more detail in a moment. Let's say, hey, yes, I do have the cash. I do need to do something. It's been a while, but I need to do something now. There's some things that you should consider. One, obviously, is the risks. So do we have how long do we want to do it? That's term. Those are risks in terms of the interest rate, or excuse me, not the interest rate, the time of the bond. And then credit considerations. How risky are these bonds? So I'll get into those in a moment. Markets and volatility, you always are going to see ups and downs in the markets. We'll talk on that. And that goes for bonds too, not just stocks. And then the valuation, where are we at? Like how expensive are things? And then ultimately, we need to consider our goals, and we'll dig into that a little bit as well. All right, so switching gears, I wanted to explain some of the risks. This is the chart showing the U.S. bond market going all the way back to the mid-70s in terms of how it has performed each calendar year. So all these gray bars are showing the calendar year returns. As an example, here in 1982, bonds were up 33%. And the red dots you see are the intra-year declines. So in other words, at some point during that calendar year, the bond market was down at some point. So as an example, going back to 1982, bonds at some point, even though they ended up 33% for the year, they were down about 2% at some point during that calendar year. We call that a drawdown for that time period. Fast forward over here to last year, you can see that's one of the largest declines that we see on this chart. In fact, it was the worst bond performance in history here. So you can see bonds ended up to the year down about 13%. However, at some point they were down as much as 17%. So if you just were invested in the general bond market and you had money invested as a tribe, there's a good chance you're underwater right now. And there's some strategies that can help you kind of recoup some of that over time. However, it was a very bad experience for people who generally invest in bonds that are conservative. So was a tough year. I just wanted to point this out because a lot of times you hear bonds are safe, you're not going to lose any money. Generally, you don't, because there's some income there. This was actually the only time in history this has happened to go down that much. Other intra-year declines were down as much as 7 or 9 or even I think 11% in the early 70s. But this was one of the worst. So bond investing and just US government investing, they're considered bonds too. They're going to have some interest rate risk as well here, or just risk overall. Year to date, you can see bonds were at some point down about 4%, but so far through the year, they're up about 1%. So they're going to have some variability there. Now I want to move on to interest rate risk, and I'm going to focus on the right side of this slide here, just to kind of give you an example of what happens to the different types of bonds given a change in interest rates. And this is why we saw such a decline last year. If you all remember, the Federal Reserve started to raise rates quite aggressively last year, starting around March all the way until now, really. They really went from a 0% interest rate all the way up to, well, in this case, we're about 5.5%. But when you have an interest rate rise like that, it impacts your bonds. And you can see here a 2-year UST, that's a 2-year US Treasury bond. What you're seeing here is a 1% rise. I'm going to focus on the gray bars, or not the blue bars. 1% rise actually doesn't have much of an impact, but as you start getting out to a 5-year or 10-year, you start to lose some of your value of the bond. And then you get out to a 30-year bond, that's where you can lose as much as 13%. So in other words, interest rates, when they change, they do have an impact overall to the portfolio. The bottom half of this chart are more what we would call credit risk type of investments or bonds overall, which have some interest rate risk, but we'll speak to more of the credit risk in a moment. But they're more about, hey, they're risky. The company can go out of business or something like that. So they're not likely to pay back as much as you would for a US Treasury, where they're deemed the safest securities in the world. So just wanted to give you some impact of how interest rates do impact bonds. On the flip side, the blue lines, that's if interest rates start to fall, then it's probably a good opportunity to be in bonds right now. And I'll talk about that in a moment, why I think it's a good reason to do so. But overall, interest rates do have risk, or they do have great risk for your bond portfolio. So trying to stick to the shorter term generally makes a lot of sense for tribes. When there's longer term strategies in place, then it may make sense to use all the other pieces on here. All right, now moving to credit risk. We just went over what we would call term risk or interest rate risk. Now we're going to talk about credit risk. So the safest securities in the world are going to be the US government securities. Then I would put something in the middle, which is just the general bond market. Then I put some of the riskiest bond securities out there, the US high yield bond market. So starting out with the US government, I just picked a 1 to 3 year term here. This is showing what the best good year would look like in general. Yeah, you can probably get 6-7%. However, a bad year, you can lose a little bit, and that's reasonable. Once you start getting into the general bond market, this does have more credit risk out there. So this could be companies like, say, Sprint, or just other corporate companies that you see out there that may have a lot of debt on their balance sheet and just a little more risky. So you can see, yeah, they do see some downturns in a bad year, but they could have a good year too. And finally, on the US high yield market, these are going to be the riskiest securities for bonds. You could do pretty well like stocks. You can see the upside here. A good year would be pretty good, but the bad year, you could lose 23, 24%. These are just examples, and uses some historical data. But the point that I'm trying to make here is, when you're considering investing, you not only have to consider the term, how long you're going to do that, but you also have to consider the risk of the bonds that you're getting into. Generally, tribes will default to the US government securities due to restrictions. However, some tribes do have some permanent funds or long-term funds that they have a lot more flexibility with, or their enterprises have a lot of flexibility. Then they have to consider these other two columns with the US bond market and the high yield. All right, So now I want to talk about valuations and why I think it's a good opportunity to start developing a bond portfolio, because we're actually in a pretty good position. So what you're seeing here is all the different gray bars are the ranges of how expensive or cheap bonds have been for different types of bonds over the last 10 years. So I'm going to focus on the fourth column in that says treasuries, just to kind of give you some insight there. So in other words, what that's saying is treasuries, that blue dot you see, when it's at the top of the bar chart, that means it's on the cheaper end. When it's at the bottom of the bar chart, that means it's more expensive. So the blue dot you can see is towards the top. The green bars are just the average over the last 10 years. So you can see all these blue dots across the way are all above the average, which is again, that green bar, but in many cases at the higher end. So what this means is, hey, we're buying at a really cheap valuation. Although interest rates could go up a little bit more, you're in a pretty good position because now you have some higher income, and these are just the current income streams you can get. So 4 or 5% or 3.5% with munis. There's a tax differential there, so that's why that looks lower. But you can see the risky ones on the far right, high yield 8.5%. So it has some, you can get some pretty good income, but similar to that slide that I showed you a while ago, there is a lot of risk there. So bonds in general, they're cheap relative to the last 10 years or even to going back through history. So there is a pretty good opportunity to do something there. Now, before we get into our breakout assignment, I do want to go over one more slide, and this is more specific to tribal governments, and I guess even corporations that are just trying to invest some of their excess cash. Could be the enterprises as well, because you would generally want to use a U.S. government security. Here is the U.S. Treasury yield curve. So what you're seeing here, that blue line it's essentially the current interest rate stream for U.S. government bonds. So it starts out with a 3-month, then it goes to like a 1-year Treasury, then a 2-year Treasury, and then a 3-year at 4.7 and on way all the way out. As I mentioned, just 3 years ago or so, the interest rates were way lower. So back then, the income benefit wasn't really helping you out, but today it is. So as an example, you can buy some 1-year treasuries and you can get about 5.4%, and then 2 years at 5% and so forth. So these are really good interest rates to get some income without taking a lot of risk. If you start going out to, like, say, the 7, 10, and 20 year, then you start to incorporate some of that term risk, but you can lock in the rate. So this would be a good strategy if we had some, I guess, expenses or liabilities that were projected to happen in the future. We can offset those by locking in these longer term rates. All right, so let me talk about the breakout assignment briefly. Just kind of want to figure out what we'll be doing here. So first, we're going to go through a brief exercise to walk you through the impact of inflation without income offsetting it, and then with income offsetting it. So we want to get some feedback from you all in terms of, hey, what's a reasonable wage and project allocation that we can plug in here, and show you what that impact has or could have been or could be over the future of the 1, 2, and 3 years over time. And then on the right side, obviously, we'll dig into some of that income there. Then the next step, I want to just go through the investment policy and why we want to do that. So I'm going to briefly talk about this, and then there'll be a few steps that we'll do on the breakout session. In this case, we say that, why do we need an investment policy? It's really like a guide, a roadmap to what the investment plan is. It's good for current employees and committee members, but also future employees and committee members, because then they can read it. All right, this is what we're doing. That's easy to follow. Just kind of help set the foundation. It does establish the objectives and constraints, governance, all that kind of stuff. But one really important thing is it does clarify responsibilities, which establishes accountability. So we always want to make sure that, hey, what roles are defined and who's doing what. some benefits. It helps assist you all with your fiduciary responsibility. It sets a framework for what we would call prudent investment management philosophy, or just strategy overall. It does serve as a source of just history and stability for leadership. They can rely on that document. It's a source for reference and review. Hey, if I'm new to the organization, I can pull it up and get some insight from it. Or if I just need to remember it, I can go back to that policy. It helps with transitions. It should be a living document, meaning that it should get updated periodically. Every 1 to 3 years, you should be looking at it to see if changes need to be adjusted. But as I mentioned here on the last point, is it should be adjusted to meet obviously the dynamic market environment. Things change and investments change. So one of the follow-up exercises that we'll do here is just kind of go through these key components. What's the purpose and the scope of it? What are the duties and responsibilities? What kind of return and risk objectives are we looking at? And then constraints and monitoring changes. So with that, I'll go ahead and show what the the plan is for this. Got to see how many we have. I know we're planning on either doing a big group session or separating it. Let me see if Carla's available to.
Yes, we have actually an even number across all 3 breakout sessions. So I think we'll be good. Paul will lead one, Rob Eltholz will lead another, and Rob Papillion will lead the third. And then Wes Benally and another member of our National Tribal Practice team, Marcus Benally, no relation, will also be in a couple of the rooms, adding, their little bits of wisdom.
Okay. All right. Well, let's go ahead and break out, and then we'll reconvene in about 15 minutes. Next steps. We went through just a brief overview of the kind of the income benefit and how that helps offset inflation. Then we just talked a little bit about the investment policy and the importance there. So what can you do now going forward? Let's say, how do you start earning income? What do you need to do? One, consult with us or a fiduciary advisor. The reason I plug in fiduciary advisor, you always want someone to act in your best interest. And that's something that we operated as. We have operated as a fiduciary since we started actually 26 years ago. So that's our role, and that's how we help our clients. Open up at a brokerage account that's usually at a custodian. At that custodian, that brokerage account will deposit funds either through wire or ACH to get those accounts funded. And then we look at, hey, what about an investment policy? Just like we walked through a while ago, what are those key items that we need to outline to build a strategy for the policy and so forth. And then lastly, just how do you design and implement that strategy? There's a few ways. I'm going to dig into some of these in a moment, but liability or expense matching. So let's say you have some needs of the cash. Let's say you get all the funds in January, but you don't really need to use them until December. Then we would want to develop a strategy that would match that. So we would say, all right, we can buy 10 or 11 month maturity bonds, and then by the time you need the cash, it will be there and you're going to get some interest. Could be cash flow timing, just depending on when you're getting it versus when you need to spend it. So it's similar to that, but not exactly matching it. And then do you want to take term risk, which is kind of interest rate risk, or credit risk? And how do we want to design a strategy around that? So what does that look like? One, we want to determine the goals, similar to the IPS, where we look at the purpose, the goals, the risk, the time horizon. But more importantly, what I think is scenario analysis to help you determine what does that look like. And so before we wrap up here, I wanted to show you just a sample analysis on what that kind of looks like overall. So here, what you're seeing is just general analysis that we ran it for the last 5 years. We took a $2 million portfolio, where it started, where it ended, just kind of given some inflation adjusted ending balances. But really the key thing that you're trying to get here on this part of the analysis is you want to know what your best and your worst outcomes are. So you can see the best 1 year and the worst 1 year. So you can have realistic expectations as you start to build out that strategy in terms of, all right, am I really going to do okay here, or can I risk quite a bit? And there's a term that we like to use as a maximum drawdown. You can see here, down 4% at any one point in time. So that feels pretty bad at that point. However, if you hold it through a period, you tend to do better over time. On the bottom side, you can see the portfolio returns overall. I wanted to point out that these are bonds, and you can see these are monthly returns. There's a lot of red on there, probably more black, but the point that I want to make here is on a monthly basis, you're going to see changes in values in your account. Just because interest rates change, there's a lot of factors, the markets change, all that kind of stuff. But you can see you start out with 2 million, but you end with 2.1. So it does work over the long term, but it does have some pretty steep ups and downs while you're going through it. So just wanted everybody to be aware that, hey, you're going to buy it, it's going to move in the interim. However, at the end, you usually get your par money back and then the income over that time period. Another factor that you look at, or at least on the analysis, is credit. Here you have AAA rated, AA, single A, B, and then non-investment grade, so high yield and so forth. You can see this portfolio is specific to being higher quality. So that's the credit risk that we're talking about. And then on the right side here, we're talking more about the term risk. So what kind of maturities are we looking at? The longer we go out in the term, the more interest rate risk that we're going to have. In this portfolio, you can see it was usually less than 10 years of a term, with the bulk of it being 1 to 3 years or less than 1 year. So really important to kind of look at an analysis like this to give you some insight of what risks there are and how you can navigate those risks. And then lastly, what I'll touch on is just the drawdowns. I mentioned that a while ago. This is showing the periods of drawdowns and how long they last. So the longest drawdown was 3.91%, or the time frame was nearly 1 year and 3 months, but the drawdown was down about 3.91%. So there could be extended periods where it does go down, and this was one of the worst time periods for bonds over that August period through October. But you can see the other periods are usually 1 month, 3 month, not too far off. I will say that first drawdown that you see there, that was one of the longer drawdowns that you typically see, and that was really driven by the Fed raising rates. So just wanted to walk through that sample analysis there. Looks like we're getting close to the end of the hour, so I wanted to just pause here to see if there's any questions. We've got me and the Robs. If you all have any questions before we wrap up, we'll entertain. So.
Hey, Paul, I think you've already answered it, but in our previous breakout session with Rob, there was a question in the chat, just posed by one of the participants about, we talked a little bit about an investment policy, the frequency in which a group should maybe take a look at it, just given current economic conditions, and then when going through that policy, would it be recommended to use like a CFA or somebody to kind of go through that? I know you kind of elaborated on it, but maybe you want to, just provide a little more confirmation on that. Thanks.
Yeah, of course. Good question. Don't necessarily need a CFA, just someone that has experience in the area and has experiences with investment policies. Because again, we're really just trying to isolate certain areas that could be of risk, or both from the investment standpoint, but also personnel standpoint with the duties and responsibilities. But it is always good to talk to someone that has experience in that level, because we don't want to leave out things that we should be including, or vice versa, including things that we should not be including there. But a good question. All right, I think we're up to the hour here.
There is one more question in the
one more
chat,
question.
Paul,
Let's
if you
see.
would. And folks, I should have mentioned earlier, you can unmute yourselves actually in this session if you want to just speak up, but the chat works also. Go ahead, Paul.
All right, yeah, here's a question. How does one account for losses? So that's a Wes question. I'll relate to him, but essentially my understanding is you're going to have your income, unrealized gain or loss. or even realized gain and losses. I'm assuming that would go into the realized platform, Wes. Does that sound right?
Yeah, I mean, so that's one thing too. Another, I can kind of speak to experiences. A lot of time when your financial advisors or your brokerage firm will communicate to you activity for the year, whether or not, you're either making money or not making money, if you will. Sometimes the translation from what they're communicating to you to when it comes down to accounting, or from that standpoint, it could be a little bit different. But when you account for losses, I think you could take a look at, in the statements, they'll have those respective unrealized. Basically, you're holding paper, it's going up and down. You have realized, there's actual cash losses, and then the other part of it that would reduce your investments from an accounting standpoint would be dividends. So, but there's probably other things in there that Rob, the two Robs, and Paul, I didn't notice that, but can further elaborate when you guys ask them, you reach out to them. So, but
Yeah.
Yep.
And we have the contact information. Shoot any one of us an email, and we'll get back to you. And hopefully we have time for this last question that came through. Just mentioned the outlook for bonds. Can I share what that is? I will say the outlook is way better than it was a year, 2 years ago. Interest rates are much more appealing. We're actually getting paid to just really stay conservative, even like cash and so forth. So that's one outlook just from a perspective of where we're at with interest rates. But generally, bonds will have some volatility when interest rates start to rise. We're at a point, we're at the latter stage of the interest rate increasing cycle. So our anticipation is that the Fed will probably raise rates a couple more times, but most likely the bond market has priced in a lot of that. So there's probably a little less risk, or I'm venturing to say that there's less risk in bonds, I guess, where we're at right now, especially because we have that income threshold. So if rates go up a little bit and we're still getting 5% income, maybe that will drop down the total return to 4%. So it's a much better position than we were over a year ago or so.
Yeah, and I'll just add one portion of it there is that this is as you saw that yield curve earlier that Paul showed, where we're being compensated more for shorter term rates than we are for necessarily longer term, holding it for longer term. This is very similar to the way it was in 04, 05, and 06, because back in 04, 05, and 06, we had the Federal Reserve where they were increasing rates. So the shorter end of the curve was much higher. Thank you, Paul, for going to this. And what folks were doing is they got into a little bit of a trap. And I'm seeing it now too with a lot of clients where they're saying, well, why get something longer term? The reason being is that when the Federal Reserve has to start lowering rates again, because it's going to happen, if you're having everything on the short end, your reinvestment risk, as Paul mentioned earlier, you're not going to be looking at reinvesting at lower rates for the future portion there. So going out on those years of maturity, that 5, that 7, and that 10, where you're being compensated at 4% or right around 4%, when rates come down, when they start lowering them again, we're going to be looking at those getting some actual appreciation of value as well as clipping that coupon. So that's something to really consider. And that's why when we look at building out some sort of portfolio, we want to look at when's money need to come due, and do we need to take that? Where do we need to start having things come due? So having too much on the short end, when rates come down again, when all these come mature, and if the Fed starts lowering rates, let's say again in 2 years, well, now you're going to be reinvesting at a much lower rate opposed to being locking in at these rates what we know now at 4 or a little bit higher than 4 across the board. So it's something to consider.
Thank you, Rob.
You're welcome.
There's the last question for the slides. If
And
you
yes,
I'll let
I
Carla
can
go
speak
on
to that, Paul,
Yeah.
if I may. Yes, by about this time tomorrow, I'll be sending out a copy of the slides and a link to the on-demand recording. Of course, the breakout sessions are not included in that portion, but you will get both those things. Well, let me give myself an extra little time. By the end of day tomorrow, you'll have those materials. And maybe Wes could speak for just a moment to other upcoming tribal finance workshops. Unless we lost him.
Yeah, I think we did.
well, I can speak to them actually. So we are going to be, thanks for joining us for this interactive session today. We're going to offer 3 more topics in the coming months, one from our accounting and advisory services group, one from audit, and one on human resources consulting. So please do watch your emails for those announcements coming up, and we hope you'll join us for those as well.